Good night, my friends. Just wanted to go over what I'm doing right now to just manage my finances a little bit. Uh, we'll focus on this section here. And mainly, I have to look at rebalancing my portfolios or getting them back into line in terms of my tolerances and where I want them. I I looked this up quite a bit, watched quite a few videos, read like one article, so I'm well researched in this. But I really looked into this and wanted to make sure I was making the right decision. It's mainly for my Roth IRA. In my Roth, I have it to where the my growth section has really done well and outperformed all my other sections, and it's way out of whack. I think it was really at 15%. I upped it my target percentage to 30, and it's really out of whack in terms of that. And I want to get it back into alignment with my tolerances and where I want this portfolio to go, especially since it's a long-term portfolio. And over time, I will go ahead and just change these percentages and targets as I go on. Probably the growth portion of it will take up less percentage or have less weight, I should say. I'll put a couple links to some videos that I did watch on the matter. One stood out to be like a very good video. I think it's like volatility trading solutions. In fact, let me just look it up here. But his video was quite nice and to the point. And there were quite a few others about M1 Finance itself and how it handles it. And then everything basically just says, hey, just with M1 Finance, don't actually rebalance your portfolio. Don't press the button. VTS Brent Oshef, Osachchoff. So a lot of them said, you don't really have to quote unquote rebalance, which would cost you money over time. And this is something I worry about, especially this past year with learning M1 Finance and making some mistakes in terms of how I organize my portfolios. So what I'll be doing is just putting more money into it when time comes, especially for my Roth IRA. Since I am under, I believe, the age of 60 is that cutoff. So I'm under the age of 60, so I can't invest more than $6,000 into the portfolio per year. In this case, I've already done that for the year of 2020, so I need to go ahead and get prepared for the year 2021 and putting the next $6,000 in there. As I said, it's out of whack. I did the same thing for my positive portfolio. As you can see here, my Roth IRA is mainly one pie, the growth pie, and then these are all other ETFs that are available or that I've chosen here. My passive portfolio is mainly pies of individual stocks. So, calculator I came up with here, I think these numbers are right. I'm not always the best with math, but in terms of what my actual percentage is, what my target percentage is, what that amount of this value is, as you can see, it's off a little bit. These are the numbers that I get from the M1 Finance app itself. So it equals to less than 100%, which that just means that this is probably 2.14, 2.43 or something like that. And that's why that's why it doesn't equal 100%. It annoys me a little bit, but it is what it is. It's not a big deal. The point gets, or we get the point here, really. So the biggest thing is I want to see the difference between where I am and where I should be. The difference here is I should be taking away $3,500 away from this pie, which means I would have to sell out of good earners or movers such as AT&T. Well, that's more of a good dividend paying stock, and I have like 30 shares of that, and I want to keep that. Tesla, Square has done very well. What else? Cloudera has done very well. CLDR. So I've done quite a bit in that section. fact, let me just bring it up on my phone here. Portfolio, Roth IRA, growth. So yeah, that has some of the biggest earners, or the best ones, the best performers would be Square, AMD, Tesla, Elastic NV, so Elasticsearch, so that's ESTC, ArcW, Disney, Cloudera, which is CLDR, MongoDB, MDB, Oracle, ORCL, Microsoft, Cisco, and AT&T. So those have been the, that's in order of like best performers in that portfolio since I purchased those. So a lot of these were established and purchased at different times, mainly during the downturn in March, and hopefully we can get something like that again in the next coming months, maybe in April or something like that, is what a lot of people are talking about in terms of like, hey, this is when possibly the stock market might crash or have another downturn. You never know. You can't time these things. Just have your money ready. So, per my calculations, I did a quick calculation here, or did a formula here using this sum if. So only sum the values that are positive values. So as long as they're greater than 0. In this case, so it just doesn't take this into account. Same thing here. It won't take these values into account if they're negative. So this means that to bring these into balance, I need to invest another, say, 3,600, 3,563.89 into the pie itself. Again, I can't really do that until 2021, when I'm allowed to make contributions into my Roth IRA again. In terms of my passive portfolio, to bring that back into balance, I would have to invest about $35.80 and 2 cents. And I think these calculations are correct. It pretty much would bring, hey, this value based off of this value, it would bring it into 25% category. Now, that's to say, based off of this, of course, when you put more money into it, that 3,500 will be added to this 9,800 here. And that's kind of an obvious one, but it's just something that, I went through, I did the math on it, make sure that it looked right. Now, with that being said, why is that off so much? All right, good. All right, so just to go through, show you the formulas. You'll have your actual percentage, which is just a number. Your amount, which essentially it always references D24 in this case. So it statically always references it when I copy and paste the formulas down. So that's $D, $24. Always reference that value. All other values will auto increment. So, and then times D26, which is this value here, divided by 100. All right. So that should give me my actual percentage, and that number is pretty spot on. Like, it's pretty close. Again, you have the variance in, it's probably 73.82 or something like that in terms of percentages, or the in terms of the exact value. Target percentage is just a number, 30%, and then the difference is going to be D24 times F26 divided by 100. So in this case, F26 is where I want it to be, minus where it actually is, which is this here. So I'm off, out of whack. It is over by $3,500. I would need to sell about $3,500 worth of stock in this portfolio, in this pie, just to get and take those proceeds and distribute them across all the others. As you can see, the formula just increments by 1 for each field, for each cell. So you can pause that and, or pause that as I went along here, just to see what that looks like. Then I add all of those up. I add all the positive values up. In this case, I had to look up how to do that, and that's where I came up with this estimate, or this estimation in terms of what I'm going to have to put in there. And that's fine, because if I would have rebalanced, I would have lost maybe some of my Tesla, some of my AT&T, which is a great dividend earner, and it's even greater now that it's actually in the positive territory again. So that's really good. And the same thing here. And I'm not too far out of whack here, where it's like, say, you'll hear some videos where they talk about, well, if your portfolio or a portion of your portfolio is like $1 million, this number would be quite a bit, and would be best to actually rebalance by selling out of some of your high performers here, your high earners, in your other portions, such as like this one, which is taking up actually 44.10% of the portfolio. Again, way out of whack. But in the industrials is where I have Tesla, because when I did all this, I just looked at Tesla as a car company, and that's an industrial thing to me, instead of like a consumer product. These are arbitrary names and arbitrary categories or categorizations, so it's not a big deal. I mean, I could have named it A, B, C, D, E, F, G. So with that, in there is Tesla, and Tesla's just freaking done crazy, really, really good. In consumers, that one has, again, I try to look for stocks that no one's talking about anymore. So one of them, of course, or two of them would be Uber and Lyft. Uber has done a lot better than Lyft, especially with their food business or their food delivery business. Lyft, I believe in it in terms of what it can do, what they're trying to do in terms of self-driving. Sorry if you hear like a fan in the background. It's just this Camtasia really uses up a lot of resources. I'm looking through here. The other thing in that consumer portfolio is Comcast, and there's not much going to it. But I do have about $1,600 in Lyft, and that's 31 shares. So that's pretty good. Oh no, in Uber, 31 shares. In Lyft, I have 13 shares. So that's done fairly well. Not too bad. Definitely has not rocketed back up like Uber did after the COVID recession, or COVID-19 coming up on the scene. But this is what you can do, or this is what I chose to do in terms of rebalancing and weighing out whether I should rebalance by using the rebalance button on M1 Finance, or just throw more money into it. By throwing more money into it, I can keep the shares that I do have and keep my earners and performers, and then put more money towards or put more money into the portfolio itself, so that it can grow and get more of these underweighted shares, which I'm okay with, and I think this will work out well. In all of these, and especially for my passive income portfolio, in all of these I've gone through and rebalanced. Some of them I've just rebalanced. I didn't really pay much attention to it in terms of I just like equalize them, and so they can get the same amount. For something like real estate, I gave a little bit more. I paid a little bit more attention to what were the earners and what did I have as a high earners, or a high percentage of getting the money that's coming into that pie. For instance, Equinix, EQX, and Digital Realty. I think it's like Digital Realty. Yeah, Digital Realty. Yeah, Digital Realty. This is like DLR. I've had DLR for a while, and because I just worked in that space as a network operations center technician. Real estate, bonds, ETFs, real estate. Knowing about Equinix, and knowing about how, DLR, knowing about how these things work in terms of data centers and things like that, and how important they are. And yeah, you can lose money on them, but at the same time, they're very, very valuable pieces of real estate. And if a company can manage those real estate assets well and get larger companies, larger tenants in those spaces to rent out the co-location spaces, and also some of the other services that they offer, such as connectivity services that span the nation, span the globe really, then they can be very profitable. But they have a large upfront cost, and they have large operating costs in terms of, like, making sure that these things stay up and running. But the thing is, they always stay up and running, and it's kind of the biggest thing, unless some data center really goes down and they just do really poorly. So I guess you can't say always, right? So Equinix was an underperformer. I had it at 20%. I moved it down from 20% and moved it down to 15%. DLR, moved that down to 15%. And then moved up Alta Source Portfolio Solutions. I had that at 1%, and I just, got a position in it just to get it because it was a bit of a stock tip from, one of the sources, or one of my information sources on YouTube. And I was like, oh, okay. And then I looked at it and how well it has performed in the short period of time that it's actually been in my portfolio. And it's gone up 6.75%. So something like that I thought was really good, and I want to really get behind that. And if I just looked at, what are my biggest earners, putting more towards Store Capital, putting more towards taking some away from Simon Property Group, and putting more towards Realty Income Corp. So those are the changes I made in that real estate pie, and I did a couple different changes in telecom and tech as well. I will be putting the links for my portfolios in the description. Let me make sure I get those. Darn it logged me on my account. But I'll get those links in the description for everyone to see. And of course, they don't show the real value. They only show for like $100. But currently, I'm at about $17,939.92. So pretty well, doing pretty well with that. It was up to 18 grand the other day, and it's had a bit of a market pullback, or it had a bit of a pullback because of the market, which is it's okay. It's not a big deal. It's not crushing me, and when you're going through rebalancing, that may or may not be a good thing, just depending on how bad those corrections are. The biggest thing is, since it's so out of whack, and one portion of my portfolio, or one portion in each one of my portfolios, is so out of whack, it could actually totally destroy me. So, and that's one thing you'll see in the VTS, or the Volatility Trading Solutions video that I will be linking. Alrighty, as always, thank you very much. Peace.